Hey everyone, thanks for making it out this early. Exciting panel here. Topic is search for sustainable alpha in a crowded market, and we have a great panel here. Maybe quick intros before I dive into the debate. My name is Xiao-Xiao. I'm an operating partner at KKR. I lead the crypto strategy, amongst other things. KKR is one of the biggest private investment firms in the world with 700 billion AUM. And then we've been doing some digital asset stuff over the last couple of years. Samantha?
Hi. I'm Samantha. I'm with RockawayX. We have offices mainly in Europe and Dubai. And we're a crypto investment firm, so we run venture, liquid, and market neutral yield strategies.
I'm Giovanni Vicioso, Global Head of Cryptocurrency Products for CME Group. For those unfamiliar with CME, we are the world's leading derivatives exchange. Been in business now for 180 years, really helping market participants across 6 major asset classes, and maybe call it 7 if we include, be so bold as to include crypto as a 7th asset class. But our products, we offer futures and options on futures and help both institutional and sophisticated individual traders really manage risk and gain exposure. We entered the space in 2016 with the introduction of the Bitcoin reference rate, which then served as the basis or the benchmark for our regulated Bitcoin futures contract, which were launched in December 2017. Fast forward to today, we offer reference rates and real-time indices covering 28 different coins and tokens, and we offer futures and options on futures on both Bitcoin and Ether, and most recently futures on Solana and XRP.
Hey everybody, I'm Kevin Kelly, one of the co-founders of Delphi Digital. We do crypto research, consulting, and early stage venture investing across our 3 primary businesses: Delphi Research, Delphi Labs, and Delphi Ventures.
Good morning, everybody. Tom Siegel with Off the Chain Capital. We're a registered investment advisor, been around since 2016. We're a Bitcoin-centric or focused investor. Allocating to the space. We have one fund right now, has 220 qualified purchaser investors, and we're kind of a hybrid between private equity, mid-late stage private equity, looking for relatively near-term liquidity and liquid opportunities. We do not do early stage or really mid-stage venture.
Right, very diverse set of perspectives. Now, I mean, in a market that over the last couple of years has been so dominated by essentially Bitcoin performance, right? Everything underperformed essentially Bitcoin. So you could argue like the Bitcoin was the market, was the beta, right? In this environment, and we may like be in the precipice of getting out of this to be seen. But in this sort of environment, let's say call it the last 2-3 years, what has been sort of your approach or strategy or process to actually identify pockets of alpha? It has been very difficult for a lot of fund managers and investors. How have you sort of approached this? I think it's just from a process perspective first, before we dive into specific topics. What's the start? Maybe Tom, you want to start?
Sure. So alpha. How do we create or sustain alpha? So alpha is risk-adjusted return, right, above your benchmark. Our benchmark is Bitcoin. So we think that we set our benchmark pretty high. So how are you going to outperform Bitcoin? It's done pretty well, right? I guess historically, been around since 2016. Some of the bigger ways that we've generated alpha is we were one of the largest buyers, over hundreds of the Mt. Gox bankruptcy claims. And so if you think about that, it was very indeterminable or undeterminable when the payout would be, and so there were a lot of forced sellers, so we could get those claims, which is primarily BTC, in a basket, a claim basket. So we could give those a 50, 60, 70% discount to the basket. So then if we were just willing to hold them till it was paid out, right, you get the appreciation of Bitcoin, but then also your discount goes away. So that was, we got paid out with that last year. That's one of the big ways. Another one was we were big investors in the private trust space, so with Grayscale, Bitwise, Osprey, and the like, where we could actually, that kind of flips the other way. where you could buy in at NAV, but if that then gets publicly traded, a lot of times those traded at very large premiums, 10x or higher to the NAV. So there we're creating alpha because we're buying it in at NAV, but generating a premium and then getting liquid. And then there are also a lot of mispriced assets, we think. There are some, last example, I guess, there are some where even before Bitcoin Treasury was all the rage, Bitcoin Treasury companies, there were some that we were trading on the secondary private market that had more Treasury, more Bitcoin in their Treasury than really the company was being traded for. So those are some examples of how we've seen alpha over the years.
Yeah, I would say I would say for us, we take both the top-down and bottoms-up approach. So I was a global macro strategist in a prior life, so a lot of what our work over the last several years has focused on is first understanding where we think we are in these cycles, because the crypto market has been and I think will continue to be very cyclical. So understanding where we think we are in the cycle, and then to your earlier point, understanding when Bitcoin is expected to outperform pretty much everything else, which it has for the most part over the last, call it 18 months. And where that inflection point really becomes where investors start to go further out the risk curve, the macro environment and the backdrop is favorable for taking on more risk, and trying to identify, really, I think the biggest alpha opportunities come when there are periods of either heightened uncertainty or something that is soaked in controversy. So a good example would be back in March and April of this year, right, where you had the kind of tariff tantrum, as we called it, with massive sell-offs in risk assets. Everything from a macro perspective and our kind of longer cycle analysis and some of the top signals that we track internally were telling us that was a great opportunity to buy the dip, essentially, because nothing from a longer term perspective had changed our thesis on a lot of the things that we were in. So just identifying where those pockets of uncertainty are and being capable and ready to size in and prepare to size in when those opportunities present themselves. The other quick example I'll give is we look for a lot of sectors and then products within those sectors that we think will be category leaders. So a good example was early 2023, we started to get really excited about the potential, novel tech that Solana was building. And this was at a time, for those who are around and can remember, this was when Solana was essentially left for dead by many. It was after the FTX implosion. There was a lot of negative sentiment around it. We thought it was very mispriced because not only was it going to enable new and novel applications, but the faster, cheaper block space narrative we thought was going to attract a lot of trading activity and therefore was going to accrue a lot of value to the underlying SOL asset itself. So trying to identify those types of opportunities is where I'd say we spend a vast majority of our time.
Yeah, and for us as a derivatives exchange, we don't pursue, say, trading strategies, unlike, say, my fellow panelists. But for us, it's just important to engage with clients, really, and provide the tools that clients need to execute those strategies, right? So we focus on building, say, the liquidity and infrastructure that's needed for clients to confidently establish these different strategies, including, say, alpha generation. I think when you look at what we've built since we launched Bitcoin futures in December 2017, we're now trading over $10 billion a day. So really providing the liquidity for, say, risk management exposure as well as alpha generating strategies. Looking across our suite, we see clients engaging, for example, in covered call writing, again, say, a Bitcoin position. We also see clients active in basis trading. And we also offer mechanisms that help clients execute these strategies. For example, we have a time-tested mechanism called Exchange for Physical, and that mechanism allows market participants to efficiently exchange a position, say, in a spot market for an equivalent position in a futures market, which is a tool or a mechanism that could be really effective for alpha generation and especially for those that are pursuing basis trading.
Yeah, I think so for both the venture and market neutral yield side, which is essentially putting capital to work across DeFi on chain. I think in both we feel it's generally been harder to find alpha, kind of like a growth market versus value in traditional equities. And so when it's harder, it feels like we have to do less bottom up and a little more hands-on. And so on the venture side, that's meant like a little less getting excited about turning over rocks and seeing anything that looks reasonably priced, and more doing hands-on like company building. So we've tried our hand at some incubation stuff where we see a gap in the market and we think we have some edge in getting it off the ground or being a first customer. More restructuring or PE style, so where we've seen a business that we feel has, I don't know if it's either a tech value prop or some edge that can be repurposed, so maybe launched in a new market or changed in some way. So that's on the venture side. It feels like the theme's just been, it's harder, so we have to do more and be a little more creative. And on the yield side, I guess kind of like everyone here said, it's less looking for headline rates. It's always been that, and more looking for mispriced risk. But we don't find that as much anymore by looking at vaults on different platforms and just saying, all right, yeah, 4% on a, like yields are lower. The passive allocating feels tougher. So similarly, we've had to say, like, where do we have a unique view? Where do we understand a risk better than anyone else? And so sometimes that's meant feeling like we get an issuer better, or we're closer to them, or we really understand one collateral asset, and then we follow it across DeFi. And it's also just meant having to build the opportunity set. So whether that's steering borrowers, so as a lender, to a platform that we have a lot of confidence in and where we have much more transparency, or doing setting up whole new businesses that we can lend to where we have confidence. So capitalizing on still how fragmented all these stablecoin markets are. That's an area we have found a lot of alpha. So setting up a solver division. I think it's just been having to be a lot more hands-on.
Okay, let's dive into maybe some of these themes that have been discussed as alpha in this cycle right now, right? And of course, you could debate anything that is too consensual or where everyone agrees it's not alpha anymore, it's beta, right? But the way I see it, a couple of the themes that I keep hearing about, right? It's one, there's definitely something around debasement of fiat currency and everything around Bitcoin and how you generate additional yield on top of Bitcoin. That's how you can beat Bitcoin as the beta, right? Related to that, probably that convergence of TradFi equity markets and crypto markets, sort of the internet capital markets topic. Bitcoin treasury companies, it's a form of that. And then third, I would say hyperdollarization, and so basically everything around stable coins and real world tokenization of basically money equivalents and the financialization of those assets. And then finally, it's just trading and speculation. Crypto has very strong product market fit there. I think the form how this materializes changes. But maybe we can dive into each of these themes a little bit. And I believe a lot of the other sort of themes that venture capitalists might today look at and invest in, like DePIN or decentralized AI, etc., we don't really have product market fit at scale yet. So I wouldn't necessarily. So maybe just let's dive into these. Maybe on the macro side, right? Debasement of fiat. Kevin, you've done a lot of research on that side. Can you tell us what do you do to sort of differentiate, areas to focus in versus areas to stay away?
Yeah, I would say when we first started Delphi, this was over 7 years ago now, the original thesis around Bitcoin was this broad-based fiat currency debasement trend that we not only thought was going to continue, but was going to accelerate. And so if you look at the first Bitcoin report we ever put out, we did a lot of work on that currency debasement narrative. We were, I think, among some of the first to look at aggregating major central bank balance sheets, looking at monetary inflation. And so at that time, Bitcoin really was the alpha, right? We thought that if this trend continued, Bitcoin was going to basically outperform everything else. Now, if you fast forward, I think where the alpha in that narrative really lies is understanding, again, the cyclicality of markets in these cycles and where we can best estimate where we are in that cycle. Because as I mentioned before, depending on where you are, whether it's early stage, mid stage, late stage, different types of sectors, or as people like to call it, the altcoin market, everything outside of Bitcoin and even some of the majors, there are similarities to when these things start to really outperform. And I think we're getting towards more of that mid to late stage cycle where you start to see, and we've already started to see it the last couple of weeks, some of these alternative assets within the crypto space start to really outperform. I do think that the ones that benefit from the tailwind of currency basement, because Bitcoin is the big behemoth and the direction Bitcoin moves is the direction that most things move, right? And understanding those cycles is really important because, as many probably know, even the best assets, the best tokens, the best protocols can lose a lot of money in bear markets, right? So knowing where the direction is generally heading, I think is really important. And then for us, because we have a pretty flexible mandate, figuring out how far out we want to go on the risk curve and then identifying a small handful of the assets that we think, again, are doing something new, novel, are achieving some level of product market fit, whether that's Solana, like I mentioned before, a couple years ago, more recently, things like Hyperliquid and Hype. I think there's a lot of opportunity in those, and then realizing this market is very momentum driven. So oftentimes when you're up on a position, yes, it's good to maybe take some principal off the table, but these assets, especially the leaders, the category leaders, can run further and longer than I think a lot of people expect.
Tom, on convergence of TradFi and crypto markets?
Yeah, I don't think. Can you guys hear me? Yeah. I don't think a panel would be complete if we didn't talk a lot about Bitcoin treasury companies, right? Digital asset treasury companies. So, picking up on Kevin saying, like, the market leader, there's one leader, we all know who that is in the digital asset treasury space. But I think, we've seen a lot of them. We've actually allocated to a fair number of them in the space. I think, so what does it take to generate alpha in that particular space? Well, I think it's a lot of things that Saylor has done, right? So first and foremost, you need to have financial engineering, financial acumen, being able to structure products that you can take to the market. So you need some capabilities there, some brain power in your DNA to do that. I don't think all the companies going out have that necessarily. And then you also need to have its branding, and it's a marketing exercise. So I don't think anybody has more name recognition than Saylor in the space. So you need to put your marketing hat on. And then you can put those things together, but you still need to access the capital, right? So, what MicroStrategy has done phenomenal job at is you're opening the door for people that want to get Bitcoin exposure, right? They're accepting the volatility of an asset that can outperform, but they have certain investment mandates. So in the institutional environment, a lot of that are their bond allocators, or they can't take the downside risk. They want to try to preserve the principal. Some are preferring yield. So all the Strike and Stripe and all these that MicroStrategy has put out there are just feeding that market that wants to allocate capital. So you have to get really good at that, or you're not going to be one of the outperformers. But if you can get in at a 1.1 NAV or 1.2 NAV or something like that, and the company can execute and perform, then it's a great way to get the Bitcoin performance or the altcoin performance, and with some upside and some alpha. And then the last piece I think that these companies need to do, it's just like I was in the venture world for decades, and it's back to the management team and execution. And so I think managing your debt load and how much debt you have, there will be down cycles, okay? And I think companies need to prepare actually today for when that will happen. And so that's critically important. I think you'll have a lot of fallout. You'll have companies that trade at discounts to NAV, and they'll get acquired, and it'll be very interesting as this matures.
Okay, Samantha, hyper-dollarization and RWA, how to differentiate alpha?
So I don't really know actually what hyper-dollarization means. I think, I can
sounds
wager,
cooler than just stable
yeah,
coins.
it sounds very fancy. I guess it just means like more stable coins on chain. So
more US dollars on chain,
yes,
basically.
Yes,
yeah.
Got it.
And buying US treasuries.
Yes, so hyper-dollar.
Hyper-dollar.
Yeah,
dollar
so
times
dollars on chain, and then I guess that means that on-chain capital markets are kind of indexed against the same thing as traditional. So you look at interest rates, and that's like your benchmark. I And then that feels just like recreating traditional markets. I think for us, we've tried to, it's hard for us to embrace that. Maybe I'm saying that with my venture hat of, you want to be kind of funding something new, right? But also on the yield side, like when we're putting money to work on chain, it kind of has to meet one of two criteria. So one is this risk return different in this product, right? Or this proposition than we can get on something else? So does it have a new profile? Or is this some really different investment experience, right? So if it's a new platform that we're funding where there's something that really changes how you allocate. I think a lot of RWAs don't really meet either of those criteria. And that's been a lot of the market that we've avoided. And so I think that, sort of just copy and paste stuff. If you're taking something that exists exactly in the same form in traditional, nothing new, and putting it on chain. I know when people have asked you about KKR, like slapping one fund or moving one process, you've said, well, there's going to be an adverse selection, right? That there's something desperate about that. If you already have a product that has fit and that people want, just being told, hey, slap it here in the hopes that someone will come embrace it is not so enticing. If it's a Hail Mary, maybe. And so, yeah, for us, really the mandate is what product only exists that's novel, that's unique to crypto. And so it's led us to structured products that blend some real world exposure with crypto volatility. So if I can find me after to give you some examples, but if you just roll that up into one product, that's interesting to us, where we see that it can perform across market cycles. Something where the unique composability of DeFi provides an advantage. So private lending or private credit would be an example where I can take my receipt in a pool and then maybe borrow against it in a responsible manner, but where transparency gives us more confidence on underwriting risk because it's on chain. So yeah, I think the question we always come down to is, why does this product need to be on chain if it's an RWA, and what does it offer that's unique?
Gio, you're the expert of trading and speculation. How do you think about alpha identification?
Yeah, sure. So when you look at our products, our products are cash settled products, right? Which means that at settlement, our futures contract is going to settle to the price of the spot market. So there's going to be convergence there. When you look at the products that we offer monthly contracts going out 2 years, right? So what we've noticed is that for the most part, our contracts tend to trade in contango, meaning that the futures contract is trading at a premium to spot. And that has been pretty much the case with some few exceptions. Looking back at the FTX implosion back in 23, our contracts did go into backwardation as the ability to borrow spot in the marketplace just dried up. So the only place to go short was really CME. So that did lead our futures contract to go into backwardation. But for the most part, they do trade in contango. Now, when we look at that relationship, there's been periods where that basis trade, and basis trade simply involves the purchase of, say, spot Bitcoin, spot Ether, or other crypto, and then simultaneously selling a futures position against that. Those entities, for example, don't have access to the spot market, could also execute that trade by going long an ETF and selling a futures contract. What we've seen with the basis trade, it ebbs and flows. Last year with the anticipation, say, of the spot Bitcoin and Ether products, we saw the basis running north of 20%. As the year progressed, the basis did collapse a bit, where for part of this year, it was sub 5%. But where we are now with the recent run-up in prices, basis is back up. And when we look at the basis for both Bitcoin and Ether, it is now running between 10 to 15%, which could make it, say, an attractive trade. Certainly we see some relative value hedge funds executing those type of trades. But it's also a trade that can be used for anybody, say, that is long a Bitcoin and or Ether portfolio, for example, where they can sell futures against that position and really lock in or look to lock in some of that basis.
Right. Closing statements, maybe from each of you, beyond these sort of topics that I think there is more consensus about. Can you maybe give your one-liner about where you see future areas generating, you were expecting future alpha, maybe it's not yet materialized today, but where you would be most excited about? Samantha, you want to go first?
When I leave here, I'm going to ask ChatGPT, which treasury companies based on design will be a forced seller when it falls apart? And how might I or someone else make money on that? And then that might be some alpha.
Good one.
Yeah, I think when you look across the space, so we recently launched Solana and XRP futures. When you look at the formation of basis for those new contracts, the basis currently for Solana is running north of 20%. Basis on XRP is running close to 30%. So we're seeing opportunities, say, as we launch these additional futures contracts. And I'd say that just looking across the space, since there's ample access to crypto across ETFs, centralized exchanges, and other derivatives platforms, there's also opportunities then in, say, relative value trades against all those other positions.
Thank you. Yeah, big one for us, I would say, is AI. I think most people are still very underexposed to it, including ourselves, which is why we're trying to find the best teams to get as much exposure to this trend as we can. To your earlier point, I think the decentralized AI infrastructure, there's a couple examples where we've hit, I think, early product market fit, but a lot of it is still kind of in the early stages, which is where, putting the venture hat on, we like to be, because we can see a path to where these things will actually hit massive scale and have real demand and adoption. And I would say specifically inference and the data aggregation side is where we're spending a lot of our time right now.
So I think there's real interesting pipeline of opportunities that'll come up. I don't really have the right answers today, but AI is very interesting. I like Samantha's answer. The problem is ChatGPT isn't always right, and so you have to push back on it and find out what the real answer is. But tokenization of assets is kind of interesting to me, to see what the huge winners will be out of there. But the real show is going to be the collapse of the digital asset treasury companies, and there's just a proliferation of them. I think there will be too many of them. There will be plenty that don't execute. There will be plenty that, you have these companies that'll be that they're pulling in legacy founders that are in these struggling micro cap companies, and they're gonna have allegiance to their struggling company that's non-crypto, and they're gonna come when we hit some downturn. They're gonna come if the digital asset treasury leadership hasn't taken over the company, then they're gonna really have clash heads. There's gonna be lots of good movies to watch about it. There's going to be some assets that can be picked up on the cheap. It trades at a big discount. MicroStrategy will buy them. There'll be some great opportunities in that space, I think.
All right, we already have some consensus on the future alpha, how to short treasury companies, and I guess AI continues to be a trend. All right, thanks very much. I enjoyed the conversation. Thank you all.